Hey, everybody. Welcome to the ProCare's Big Beautiful webinar, where we'll be reviewing the recently passed HR1, also known as, or formerly known as the One Beautiful Bill Act. A lot of provisions in here to digest, and we're excited to talk to you. So over the course of the hour, we'll go through a bunch of different things, but give people just a second here to trickle in, and then we'll get started. So I think we got the thumbs up that we are live. So here we go. All right, guys. So welcome to the webinar. Today, my name is Jeff Rudner. I am the co-founder and COO of ProCare. We are a modern accounting firm providing outsourced accounting, fractional CFO, and proactive tax to small, medium-sized business owners. We become the accounting department for them and help guide them through questions such as what to do with their taxes and how to optimize their business. I'm joined today by two of my partners. Larry, why don't you introduce yourself?
Everybody, Larry Bernstein, CEO at the firm, strong tax background, and also a passion for accounting systems and technology.
Awesome. Patrick? Yep. Patrick, I think you're having some
audio issues,
technical difficulties there.
I'm Patrick Osborne. Can you hear me?
Oh, there you go. Oh,
All right.
a little bit of feedback.
Patrick Osborne, head of tax here at ProCare. I lead our compliance and our tax planning and consulting. So most of these tax provisions, you'll be working with us quarterly, annually, and working through them together.
Cool. All right, Patrick, maybe you can double check your mic. We're getting a little bit of feedback there, but we'll dive in, give you a second to figure that out as we go through some of the intro slides here. All right. So what is the agenda for today? So we're going to talk about the bill, what happened, how do we get to where we're at. We'll start with individual tax updates. We'll talk about the business-specific provisions in the bill as well, and then wrap it up with some recommended next actions and questions if there are any. So how do we get here? So under President Trump's first term, he passed, along with Congress, the Tax Cuts and Jobs Act of 2017. It was comprehensive legislation that changed a lot of provisions affecting individuals and businesses. We'll go through some of the things of what changed, what stays the same, what's been expanded, and what's changed. On July 4th, he worked with Congress to pass a new comprehensive bill. A lot of those provisions of the Tax Cuts and Jobs Act were set to expire at the end of 2025. And so the new bill does a lot to maintain those, a little bit of spoiler alert there, expand them, and also cuts some provisions that were added previously by other administrations. So let's dive in here. We'll start with the individual tax provisions. And the first one that we have up is the extensions of the Tax Cuts and Jobs Act. So Patrick, do you want to talk us through what is being extended here, what was set to expire, and what does the Big Beautiful Bill do to keep the good times rolling for some?
Can you hear me now? Any better?
Still some feedback, but we'll roll with it.
So I guess before we jump into it, the one thing I do want to point out is that the enactment date on a lot of this legislation has very different provisions. So some starts effective January of 2025, some starts in 2026. So what we want to talk through is like how to optimize some of these provisions to take advantage of things that we can still take advantage of in 2025, while also still planning for the changes that are going to occur in 2026. So the TCJA, the Tax Cuts and Jobs Act, was set to expire at the end of 2025. So what that means is that everything was going to revert back pre-2017 law. But what this did was permanently enact a number of the provisions, including the current tax brackets, as you'll see here on the screen, from 10 to 37% made permanent, that increased the alternative minimum tax exemption. I'm not going to get into the details too much on AMTI, but what it does is it tries to create parity for all taxpayers, including those who take advantage of like losses, deductions, credits to help reduce their taxable income, but then tax them effectively, but giving them $1 million exemption. Not many taxpayers are subject to this alternative minimum tax, so nothing really too much to talk to there. The limitation on mortgage interest is still in effect. So if you have a mortgage on a residence of over $750,000, a portion of that will be disallowed. However, there is a change to allow for other insurance premiums to qualify as deductible with the new legislation. And then for a while now, we haven't had personal exemptions. This went away back in 2017. They continue to be eliminated in lieu of having a higher standard deduction. There was a temporary provision included in the bill that gives seniors above 65 years old an additional temporary $6,000 deduction that eliminates in 2029.
Awesome. So there's a lot of nuance there, and things to keep in mind. The tax rates didn't change, but when you mentioned the limitations on mortgage interest and tax and mortgage interest there, Patrick, I think the bill also expanded what qualifies for mortgage interest. Is that right?
Yeah, that's the mortgage insurance premiums I mentioned.
Right, and also HELOCs now. So if you have a mortgage that's below $750,000 and you utilize a HELOC, you might be able to claim the interest related to that HELOC up to that $750,000. Is that right?
There's always been a provision for the line of credit capped at 100,000. So yeah.
Okay, awesome. So something to look out for. Also, we're monitoring the questions in the LinkedIn Live. So if you have questions, feel free to send them across and we'll try to address them when we get to that section. All right. Thanks for that, Patrick. So let's continue. Let's talk about one provision that was negotiated very heavily, a lot of back and forth. This provision alone was thought to potentially kill the bill entirely, but the Republicans rallied together and were able to agree on when it comes to the SALT deduction cap. So, Larry, what's a SALT deduction and what do we have to think about now?
So SALT stands for state and local tax, the SALT deduction. And what it means is before we had the TCJA, taxpayers had state and local tax. So it's like your real estate taxes. Perhaps you paid state income tax. In Florida, you could also take state sales taxes. These taxes were deductible as an itemized deduction. Then the TCJA came in and it limited the total SALT deduction, the state and local tax deduction, to $10,000 for everybody. So for most people here in Florida, most of our taxpayers, just your real estate taxes alone are going to be in excess of that $10,000, or maybe that plus something else is going to be in excess. So you're always capped at $10,000, significantly reducing the benefit of itemizing your deductions. And what's happened now is you can take a deduction for up to $40,000 of state and local taxes. Again, you're talking about real estate taxes, sales taxes, other state income taxes, and you can use that as an itemized deduction against your income. However, this provision is only good for the next 4 years, 2026. Patrick talked about when these things phase in. 2026, 2027, 2028, and 2029. And after that, it's going to go back to $10,000. And also, the cap, the $40,000 maximum deduction here goes away if you make too much money. So you get the whole $40,000 if your income is $400,000 or below, and it starts to phase out. By the time you get to $500,000 of income, you're back down to a $10,000 deduction limit. So I think this is really good for upper middle class kind of taxpayers, but for anybody in the high income brackets, it's not going to make a difference. You're still going to only have a $10,000 deduction.
Awesome. Now we're going to hear that theme a lot throughout this presentation, income phase out. Can you just talk about that concept, Larry? You mentioned it a little bit briefly here, but as we mentioned those income phase outs going forward, it'd be great to set the stage. Then you might just pull in your microphone a little bit closer, so coming a little bit louder.
Yeah. So I think the reality is that Congress really likes to find ways to have good headlines saying, oh, we got a $40,000 deduction limit now for state and local income taxes. But the reality is that costs too much money. So one of the ways they make that provision cost less money is they make it so that it goes away. It's not as valuable if you make more money. Okay. So you'll see it here with the state and local income tax, whereas it starts to go away after you earn $400,000 of income. It starts to go away 30% for the income above $40,000. So $100,000 of extra income times 30% is that $30,000 deduction going away.
Yeah.
to get you back down to 10. Thank God for software that allows us to calculate all these things, because it can get very complicated.
But we're pros. Our software, we use the best software here, so we'll be calculating this a lot, I'm sure, for our clients. Now, Larry, thanks for that. We'll move on to the next topic here. But you mentioned as part of the SALT cap, it works out well for the middle income taxpayers. The next topic that we're going to talk about really is focused on high income and high net worth individuals. And this was set to change materially at the end of 2025. But as part of this bill, we're kind of back to where we were. So let's switch to the estate and gift tax exemption. Larry, what happened? What was set to happen, and where are we now?
Yeah. So effectively, what's happened is an extension and a continuation of current law. If you have, as a married couple, more than $30 million, you're going to be subject to the estate tax, or the unified gift and estate tax. And what that means, you can give away money during your life, or when you die. Any other amounts above that $30 million will be subject to estate and gift tax. What was supposed to happen, or what was set to happen, not supposed to, but what was set to happen was a revision back down to the $7 million number that we had before the TCJA back in 2017, indexed for inflation. So maybe it was like 8 million. I'm not exactly sure. But that makes a really big difference, especially for our client base, because we have a lot of people who are, definitely in between the $7 and the $15 million per person, and plenty who are far in excess. And so what this does is it makes this rate now permanent until another Congress comes along and changes the law again, but it does not expire. And throughout our professional careers, we've seen many times when we've had estate and a gift tax exemption cliffs, which means that the law was going to change. So everyone had to hire attorneys and try to, structure trusts and make gifts to trusts leading up to a deadline. And it was possible that was all going to happen again in the next 6 months here leading up to the end of 2025. Fortunate for many people, that did not happen. The law is now extended and gives people a lot more time now to plan their legacy and what they want to do for as far as gifting to their children and other loved ones.
Got it. Awesome. So we saw a lot of work done over the past 12 to 18 months in preparation for this. The previous expiration looks like that work was just done in advance of whenever the next Congress comes in and changes the permanence of this estate, right?
Yeah, and for clarity, it's still a really good idea to go through estate and gift tax planning, because any money you get outside of your estate will grow outside of your estate. It's not just how much money you have today, but how much money will be whenever it is you ultimately pass on. And one of the things that we know will definitely happen to everybody, myself included, is we will all pay taxes and we will all eventually die, right? It's not a matter of if, it's just when. So it's a great idea to continue this planning, but the pressure is off for now.
Lots of learnings for all of our attendees here. If anyone didn't think that they were going to pass, well, Larry just taught everyone. So thanks for that. Let's move on to the next provision of the TCJA that's continued. This was one of the more material things that affected a lot of taxpayers. Was related to the standard deduction. So, Patrick, what happened as part of the TCJA, and what's happening now as part of the One Big Beautiful Bill Act?
Yeah, so before we get into the standard deduction specifically, there's two ways that individuals can get a deduction. They either take the standard deduction, which is a set amount that everyone's entitled to, or they can itemize. So they can take into consideration property taxes, property taxes, charitable contributions, mortgage interest, and you itemize. One of the things that Larry just talked about in talking about state and local taxes. So the itemized deduction used to be very low at about $12,000 before the TCJA. And so what the legislation did now is make it so that the increased standard deduction continues on. So if you're married filing jointly, you get an automatic standard deduction from your income of $31,500. If you're married filing, if you're single or married filing separately, it's $15,750. So what that means is if you aren't going to itemize, you don't have enough real estate taxes, charitable and other activities, you would just take your standard deduction, and the increase is nice. it's going to continue to be inflationary adjusted. So you'll only continue to see this go up. So it may be harder and harder for individuals to qualify for the actual itemized deductions, which I think we'll talk about in the next slide.
That's right. So it was a pretty material increase from the when the TCJA was implemented. A lot of people that previously itemized qualified for the standard deduction and benefited from it. So this continues, and it'll be interesting to see, as time goes on and as inflation, whatever those inflation adjustments are from year to year, more people might be opt into the standard deduction. Is that right, Patrick?
Yep.
Cool.
Yeah, the 31,000 is a hard number to have enough itemized deductions for a lot of taxpayers to get over, especially when we talk about the phase out that we're going to have coming in 2026 that are going to severely impact the top tax bracket and those who are very charitable.
Cool. Yeah, we'll get to that in a few slides, so stay tuned. A little teaser there. All right, so let's talk. We talked about the standard deduction. Let's talk about itemized here. Patrick, what happened? Where are we going?
Yeah. So your itemized deductions, like I mentioned, are things like state and local taxes, charitable deductions, and then interest expense, like the mortgage interest that we talked about previously too. What this does is it creates two limitations starting in 2026. So there is the ability to plan for 2025 to take advantage of some of these provisions before they change. But what it really does is it makes sure that the 37% tax bracket doesn't get the full benefit of the itemized deductions. And it gives it basically a cap at 35%. So what that means is that if you're in the top tax bracket, you're not going to get a full benefit of all of these itemized deductions. The second one, which is also probably even more detrimental to those who are philanthropic in nature, is that it creates a minimum disallowance for charitable. So if you make, for example, $400,000, your first 0.5% of income, you don't get as a deduction for a charitable contribution. Putting some numbers to this, if you make 400,000 and you itemize your deductions, the first $2,000 that you give to charity just automatically doesn't get allowed as a deduction. So you're basically starting at this floor, and then everything you contribute above that will be beneficial. So there are some.
That's a big change.
Yeah, it's a very big change. There was a lot of concern when TCJA increased the standard deduction from 12,000 to what it is now, that there would be people who are less philanthropic and not spur charitable giving. But we may see some more of that or some creative ways to do it around these phase outs and limitations.
Yeah. So it's a new wrinkle in the calculation. Something to consider, a new factor to keep in the back of your mind. Larry, anything to add on this before we move on to the next?
I mean, just like more opportunities for planning and modeling.
Yeah.
If you want to get the most bang for your buck, there's a lot of opportunities here.
All right.
Yeah.
One new
time being, all things being equal, if you are thinking about a charitable deduction and you're considering end of the year versus beginning of next year, it's probably more beneficial to you to make that in 2024 or explore other ways to get a deduction like a donor advised fund that we'll talk about later.
Yep, got it. All right, let's go to one new provision that has been introduced, which is the ability to deduct automobile loan interest, Larry. And this is a pretty narrow focus, but might be interesting for some.
I think this is one of the examples of where the headline sounds a lot better than the reality. But what it allows certain taxpayers to do is to deduct the interest expense on a new auto loan, a new car auto loan. That car has got to be manufactured in the United States or maybe assembled in the United States. I'm sure IRS will put out a list of cars that qualify. But it's also subject to income limitations. So I think it begins to phase out when your income exceeds, for a joint filer, $200,000, and for a single person at $100,000. It begins to phase out. I'm not sure exactly where it ends, but it's not going to help that many people. Yeah. And the car also needs to be a new car. It does not work for a used car.
Yep. And it's only the interest component. Most auto loans don't have long lives, and the interest rates are typically preferential. So it's a small dollar. It's likely a small dollar amount, but if you qualify, it's definitely worth looking at. Awesome. All right. One major change that is really interesting in the way that we're going to have to think about this, or people are going to have to think about this, who frequent casinos, gamble on sports, gambling losses. Larry, let's talk about this. This is something that is a major change from history. What's going on?
I got to tell you, when I was reading this law, I was like, is this right? Is this really what they did? And I'll let you decide whether you think this is right or not. I mean, I'll tell you what the law is. You can tell me whether you think it's fair or not, or an appropriate law or not. Yeah. But in the past, anybody who is a gambler, whether you play cards or you go to Hard Rock or sports betting, whatever it is, gambling winnings and losses were able to be netted together. So let's say you had $100,000 of gambling winnings and $100,000 of gambling losses in all years in the past. You had no income to report because your winnings and your losses offset. However, if you had losses in excess of your winnings in the past, there's nothing you could do about that. You didn't get a tax benefit from losing as a gambler. In the new law, as it says on the screen, the act limits wagering losses allowed to 90% of the wagering gains. So what does that mean? It means in that same example, if you won $100,000 and you lost $100,000, you're only allowed $90,000 or 90% of those losses to offset the income. So you're still going to pick up $10,000 of income, even though you broke even and you lost, and you have to pay tax on $10,000. To say it again, let's use even bigger numbers. And let's say you lost a ton of money. Let's say you won $1 million, but you lost $5 million, a net loss of $4 million. In that case, you're going to have to pay tax on $100,000 of gambling winnings, even though you lost $4 million, because you're only allowed to offset 90% of that $1 million winnings with your losses. So this is a very interesting provision. And something that anybody who does any kind of significant gambling, whether it's on the Hard Rock app or wherever else it may be, just they should think about.
Yeah, really interesting. And Larry, you definitely, to our viewers, Larry meant it when he said you can tell him how you feel about it. We'll give you the office address in the notes here, or feel free to leave a comment, because I'm sure he would appreciate the feedback. All right. One other thing that was campaigned on, a couple things that were campaigned on for our next slide here were taxes on tips and overtime. Patrick, the campaigners, or when they were campaigning, Congress and the president talked about no taxes at all on tips or overtime. Is that what happened, or how was this implemented here?
Sure. Yeah, it sort of did. You're allowed a deduction for both tips and overtime. Tips, you're allowed a deduction for up to $25,000 of tips. And then overtime, a deduction for $12,500. So not as glamorous as it sounds. I think we were all headlining that like all tips and overtime would be tax free essentially, but that's not the case. And there's relatively low phase outs, 150 or 300 for tips, and then for overtime, 100 or 200 for joint filers. So you are allowed a deduction. It is above the line, which means you don't have to take an itemized deduction. So anybody who does get tip income or overtime income and is under the income threshold can deduct 25,000 for tips or 12,000 for overtime, but not as lucrative as all tip income and all overtime income is tax-free.
Got it. All right. So it'll be interesting to see, Patrick, if that tip jar on your desk stays, or if it goes away over time. It is a benefit. It's just a little bit of a cap. It is a income with an income phase out thing we talked about earlier on.
Something else that we should talk about here is that if you're an employer and your employees earn overtime or tips, you're going to have additional reporting to be able to make sure that this information can get out to them, and that these provisions also expire. These are not permanent.
What was the end of that? They expire when?
I think the slide says 2028. I didn't look up when it expires, but I think if that's right, that's 2028.
All right, cool. We'll stay tuned. Awesome. All right, let's move on to the child tax credit. Larry, what is a child tax credit, and what does the bill do?
So this is kind of an extension of what we already had. So it's not a major change. There is a slight increase in the amount of the child tax credit. And, if you have children, there's a small amount of money the government will give you back. And that's really it. There are some income phase outs here, which do reduce it some, but For the most part, the law continues as it was with slight increases to the amounts.
And this is a credit, not a deduction, right, Larry?
That's right.
That's right. And so just to refresh for everybody, the difference between a deduction and a credit.
Everybody likes credits better. Credits, a $2,200 credit means if you owed $10,000 in taxes, well, now you just had $2,200 paid towards it, right? And you only owe $7,800. It's an actual dollar for dollar amount. It's like cash. Whereas a deduction, instead you would take like a $1,000 deduction would be worth $1,000 times your marginal tax rate. So if your marginal tax rate was 30%, a deduction of $1,000 would be worth $300.
Got it. And we'll keep going with some deductions as we get into the business side of the bill. But let's continue with one new provision here where the president has put his name on these accounts called Trump accounts. Patrick, what's a Trump account? What's it do? And what are some considerations?
Yeah, so the Trump account allows for a one-time $1,000 payment for taxpayers who have a child born. And on its own, doesn't seem all that incentivizing because of it just being $1,000. What it also does have as a provision in it is that you're able to make $5,000 of contributions a year, and your employer is also allowed to make a contribution to what is essentially kind of like an IRA account on behalf of your child up until they're 18. So there is the potential to save up to $5,000 a year for the benefit of your children. There's a lot that's going to come out in terms of like nuances on this, but the intent is to let that amount grow tax deferred. And then when your child becomes 18, have sort of like a savings egg. We'll see what the details come out with, but there are other ways currently already available, like funding or super funding a 529 plan. If your children work, having a Roth or a traditional IRA. We'll see, more to come on this, but I think there is a potential for this to be a vehicle for you to save for the benefit of your children.
Got it. And who seeds that first $1,000? Is that the parents or is the government?
The government.
There you go. So
really all of us in part.
That's right. Got it. Okay, cool. Well, that concludes the individual components of this, at least the highlights for that we thought were news and noteworthy. We're going to move on to the business tax provisions, which are numerous. A lot of things changed when it comes to this bill. And so we're super excited for some of these, as excited as accountants can be when it comes to implementation of the tax. I mean, it's pretty exciting, I guess. So let's dive into the business tax provisions here. Let's start with bonus depreciation. Patrick, what's bonus depreciation and what are some considerations for property owners?
Yeah. So bonus depreciation allows for an immediate deduction for any short-lived assets that you purchase beginning in 2025. So if you buy furniture, fixtures, equipment, machinery, if there's a leasehold build out, anything that's a shorter lived non-building type asset, being eligible for bonus depreciation allows you to expense it 100% in the year. And what's different from how it was set was that currently we were phasing out of bonus depreciation. So right now in 2025, we were in the 40% bonus depreciation phase, with next year being 20 and then 0 the following. But what this does is permanently enacts 100% bonus depreciation. So that's a huge win for anybody who's making any sort of capital expenditures, improvements to property, buying equipment. And then one of the other things that you may hear is that 179, which is another way to immediately expense equipment, has increased as well to $2.5 million. So there's a lot of ways to take advantage of immediate expensing of otherwise capitalizable and depreciable fixed assets.
And so what's something that you would recommend for someone buying a property in order to take advantage of that bonus depreciation? Can if they buy a $2 million commercial building, are they able to deduct the entire thing, or does more work need to be done?
In terms of a building, no, not without doing some proper legwork. You could do a cost seg on a building that you acquire. So what that does is it breaks the building out into different components. So you may buy a building, but there may be a portion allocable to land, to furniture and fixtures, to improvements, to machinery and equipment. And what that does is it breaks it out into lesser lived assets. And those lesser lived asset bucket can be immediately expensed and would qualify for this 100% bonus depreciation.
Awesome. So if you're thinking about buying a new building or developing, it's definitely an opportunity for doing some planning or some additional work to optimize tax there. Is that right?
Yep.
Cool. And then just for clarification, the Section 179, what for our lay people and me, what is Section 179 and how should we think about it?
So it's always been around and it allowed for the immediate expensing of equipment or lesser lived assets. But when bonus depreciation was at 100%, most people just took bonus depreciation. 179 allows for immediate expensing, but has an income limiting component to it. So if it sends you into a loss, you may have some of that deduction suspended. For our purposes, just know that there's immediate expensing on short-lived assets.
Great. And then just a question from Paula. Is the bonus depreciation only for commercial real estate or also residential if it's rented? If you're renting out a property, can you qualify?
Yeah, it's for all short-lived assets, whether it's commercial or residential. So if you have a rental that you furnish and you have to do, a tenant moves out, so you do a ton of, remodeling, new furniture, stuff like that, it would be eligible for bonus depreciation.
Right, but it's not for your personal house. Got it. Awesome. Thanks. Cool. Well, that's a good one, an added benefit for anybody in the real estate industry or looking to get into it. A similar provision when it comes to research and development expenditures is a major change. Larry, you've been talking about this for years. I think this has been on all of our webinars since we started. Major provision. So research and experimental expenditures, what was the provision? What is it now? And how should we think about taking advantage of it?
Any business, excuse me, something's in my throat. Any business that engages in research and development now has the ability to write off or to immediately expense those research and development activities. And this is what the law was a handful of years ago. But then it was changed to be able to get this bill through on the last one to force folks to capitalize those R&D costs and then recover those costs over 5 or 15 years through what's called amortization. So now we're back to where everyone said we were supposed to be, which was immediate expensing, because it is a policy goal that folks in the United States engage in research and development and take risk. And so now we're back to where we're supposed to be. We can now immediately deduct R&D costs. Now, there's another thing that we do with R&D, which is called the research and development tax credit. That continues just like it was before, but any amount that was not available for the credit is now immediately available for expensing. So you really get a pretty big win. The other part of this win is that this law is now retroactive to fix what many in Congress had promised they would have fixed a few years ago. So for most taxpayers, we're able to now go back and either amend prior year returns to deduct capitalized R&D costs and get an immediate refund, or there are some other options to recover those capitalized costs in future years.
And so what's the recommendation here, Larry? Is it for anybody that had to capitalize research and expense and development expenses to look at the prior year tax returns, see if there's an opportunity to deduct those or amend?
I think the reality is, look, if you have any capitalized R&D costs, talk to us and we will help you figure out the best path forward, whether or not we should amend returns and try to get a refund, or whether we should do it in the future, or perhaps there's even a missed R&D credit opportunity. There are too many ifs. If you have this situation going on, we should talk.
And does this include international R&D? Is it US based only?
It's only going to be for US based R&D. So if you have your research and development going on overseas, that's not favored by the tax code. You have to capitalize that and amortize that over 15 years.
But if you have US based research and development expenses that were capitalized, you should see some benefit from this change.
Yes, absolutely.
Awesome. Great. Thanks. Let's talk about a provision that was introduced to help benefit pass-through entities and pass-through entity business owners, qualified business income. Patrick, what is QBI and who does it benefit? And who should think about QBI in the QBI deduction?
Yeah. So QBI was enacted with the reduced corporate tax rate when it dropped to 21%. And so what it did was allowed a 20% deduction from income for partnerships, corps, proprietors to kind of create some parity between the two. It was set to expire at the end of 2025. And what the bill did was make it permanent. So now all of these flow through entities that are qualified businesses are able to take the qualified business income deduction going forward. It just doesn't expire anymore.
Awesome. And so you talked about creating that parity because the TCJA decreased the corporate tax rates so materially that they didn't want to penalize pass-through business owners.
Yeah. So the corporate tax rate, when it dropped to 21%, the highest individual tax bracket was 37%. And so in an ideal scenario, you'd be able to take advantage of this 20% deduction and bring that 37% down 20% to create some parity between the two.
Right now, for this specifically, it's a pretty common deduction at this point, but it takes some work to figure it out. There's a lot of scenario planning when it comes to this. How do we typically approach working with business owners when we think about planning for QBI? Just talk us through a little bit of a scenario there.
Yeah, it's not as straightforward as everybody getting a 20% deduction. So there are limitations, like lots of tax provisions, limited to either 50% of W-2 wages paid or 2.5% of what they call qualifying assets, essentially. So what we do is we'll run projections with clients quarterly or even more regularly if necessary to see how we can optimize wages or assets to maximize the most amount of the qualified business income deduction.
Cool. So it's something that's available to all pass-throughs, but something that requires a little bit of work to optimize.
Yeah, definitely.
Cool. Awesome. All right. So another major change in the world with small business is qualified small business stock. So Larry, I know you're passionate about this. We work with a lot of startups, a lot of venture-backed startups. And so this is something that impacts a lot of our angel investor clients and the companies that they fund that we work with. So talk about what was the provision and what changed in the new bill.
So the good news is that everything that was there continues. The better news is that they made it better. Okay. So qualified small business stock, sometimes called QSBS, sometimes referred to by its code section 1202 stock, is stock that you buy from the company directly, not from someone else who owns it, but you buy stock directly from the company. A qualifying small business now means it has less than $75 million in assets. Before it was 50. And as long as you held on to that stock for 5 years, when you sold it, it was effectively tax-free. Okay. To the extent of $10 million a gain or 10 times your investment. Now, what's happened is they've moved that $10 million gain exclusion up to $15 million and also 10 times your investment. And they've also made it that if for whatever reason you get out of the stock before 5 years, you still qualify for some gain exclusion. So if you held it for 3 years, you get a 50% gain exclusion. 4 years, 75% gain exclusion. And 5 years, you still get that 100% gain exclusion. So this will make it easier and a better incentive now for folks to invest in small businesses that are qualified small business stock. And those investors, if those companies are successful, have even more benefit.
Right. And the other thing, by adding provisions for earlier application, it allows the businesses to exit sooner than they may have. So it potentially reduces the risk for investors who are looking to invest in early stage companies. So hopefully this is a marginal improvement to have angel investors investing more favorably in small businesses, increase the appetite for investment in small businesses.
And one other note here is that these new rules, the 50% gain exclusion, 75%, the $15 million exclusion, etc., that only works for stock that was purchased after July 4th, 2025. Before July 4th, 2025, the old rules apply.
So you have to hold for for 5 years, and
Right.
then the provisions from when you bought it still applied.
Correct.
All right, now, unfortunately, this bill with all of these tax cuts, these added benefits for businesses and individuals, there's all these benefits, but the Congress needed to pay for this somehow. And so there are some losers when it comes to this bill, specifically the green energy. We had in our last webinar related to it was an Inflation Reduction Act a number of years ago under the Biden administration. There was a number of green energy provisions that we talked about. Larry, what does the One Big Beautiful Act do to these provisions, and what do we need to do here?
They're all gone. Gone.
Yeah.
So if you want to buy an EV, go do it before September 30th of this year. But for the most part, all these provisions are now over or will be over soon.
That's it. So
That's it.
just like everyone, Larry's telling everyone that we are all going to die, the green energy credits are now dead, pretty much dead.
Yep.
Sorry to hear that, but due to the process and due to the way the bill was enacted, the cuts had to be offset, and so by either spending reductions, and green energy was on the losing end of that, unfortunately. So that brings us to the end of the specific provisions we're calling out. What do we recommend?
Do we have the opportunity zone slides or no?
That was towards the beginning, so sorry, we missed that. So I'm going to switch back up to the opportunity zone. Here got switched up to the beginning somehow. So I'm sorry, Larry. What's up with the opportunity zones?
Okay, opportunity zones are they've existed before, and now they're being revived again. And what it is it gave opportunities for folks to invest in blighted areas, if you will, to try to improve them. And if you did that, you're able to defer some gain and also then not pay gain on the exit. The rules are pretty complicated, and in a lot of cases, I think it's important to make sure if you're going to make an investment in an opportunity zone that you do so because it's a good investment, not because it's a good tax play. But the new opportunity zones will be announced sometime in the middle of 2026 for investments that start January 1st, 2027. I don't think any current opportunity zone stuff that's going on today should really be looked at too hard unless you have something specific that you're interested in. But it is interesting that they're bringing them back and they're making them permanent, and they'll be on a 5-year rolling period for new opportunity zones. So if you have a large gain on the sale of something, a large capital gain, you can invest that money into an opportunity zone fund and then defer it for up to 5 years. And if you hold that property for more than 10 years, then there's no gain on the exit, and a couple other things. So that's opportunity zones.
So there's a lot of requirements, a lot of things to think about to determine if you qualify. So you recommend a lot of planning in advance. So making sure that if you're going to invest, that you're going to get the full benefit. It's going to take some time for us to, or for everybody to flush through things, but you don't want to rush into these things because, as Larry mentioned, you want to make sure it's a good investment first, and then the tax benefits can be sweeteners.
The good news is that there'll be 10 years of history of opportunity zones, and you can see how those things actually performed.
Mm.
The fees in these kind of funds are usually pretty high too. So something to keep in mind.
All right. So next steps, Larry. We've been through a lot of things. We'll go you first. What do you think in terms of your taxpayer digesting this? A lot to think about, a lot of changes. Larry, you first, and then Patrick.
All right. So I got a couple things here on my hit list. If you're charitably inclined, you may want to consider a large gift to a donor advised fund, a private foundation, or a public charity before the end of this year, before the end of 2025. Why? Because starting in 2026, as Patrick mentioned, charitable deductions are going to be limited 2 ways. The first way is on the charitable deduction itself by losing 0.5% of your income, that floor. And then if you're in the top tax bracket, instead of getting a 37 cents on the dollar savings, you only get 35 cents on the dollar. So consider charity maybe in 2025 and pre-funding that. If you're an angel investor or you want to be an angel investor, qualified small business stock, QSBS just got better, shorter holding periods, for gain exclusion and larger company sizes that qualify as qualified stock. If your business is engaged in R&D, immediate expensing is back, and we can go back and deduct any capitalized R&D costs from prior years if that's desirable. If your business is in real estate or buys equipment, 100% bonus depreciation is back, along with increased 179 expensing. Even if you didn't buy new property, used property also qualifies for bonus. And we can always do a cost aggregation study with one of our partners. Overall tax rates remain largely unchanged, which is a good thing. Itemized deductions get a haircut for those in the top tax bracket. I talked about that with regard to charity, but it's across the board on all itemized deductions. The state and local or SALT deduction increased to $40K from 10, but like we said, those phase out if you're between $400,000 and $500,000 of income. And of course, anything above that. And then Patrick, you got a reminder you want to share with everybody.
Yeah, my biggest takeaway is the dates that some of these provisions are enacted. So some are already at play and have been since January or retroactive. Some go back even further, like R&D, where you can look back to 2022, 2023, 2024, and then some aren't effective until next year in 2026. Working with us to understand which ones are at play and the time frame that they're at play with to optimize what you're trying to accomplish from a tax optimization standpoint.
Cool. Actually, before we get to questions, recommendations for the all of our viewers. There's a lot in here. There's a lot of different things that changed from last year to this year, and so we really recommend working with your tax professional to understand your situation. Make sure that whoever you're working with, obviously, we're an accounting firm that would love to support our current clients. We're going to be supporting our current clients. And if you're interested in learning more about our services, we're happy to look at your situation. But the key here is making sure you're working with someone who understands your situation and then understands the provisions and how to apply them. Patrick, we're working with our clients, most of them at least quarterly, on projecting their tax liability, so that way there's no surprises at year end. How are we approaching knowing these changes and flowing these through when it comes to the projections for the rest of the year?
Yeah, so we're looking at, well, I guess there's a lot of different ways we're looking at it. If it's an accounting client, we're working with the accounting team and looking at things like fixed assets being placed in service, clients who have R&D, seeing what we can do to optimize that and when we can take advantage of some of these retroactive changes. If we're dealing with non-accounting, just regular tax clients, we're looking at positions that we've taken and really just running projections to understand which of these new provisions would be most beneficial or allow for like the most optimization for you and accomplishing like the goals that you want. So thinking through like if you are purchasing fixed assets, if you're thinking about a charitable donation, I mean, there's a lot of provisions that are going to hit every individual in business. So it's really very facts and circumstance based to each specific person's taxes.
Yep. And Larry, you quarterback a lot of our high net worth clients as kind of the fractional family office CFO. I know we've gotten a lot of questions already, but how would you recommend our viewers approach flowing these through these changes? How should they bring questions to their tax professional? And when's the right time to bring those questions to their tax team?
Well, the right time is before you take the action, and usually before the end of the year, ideally with more than a week before the end of the year, so we have some time to actually make the actions. But there's I think a continuous conversation is the way to go. Tax planning is not an event. It is a journey that we are always on together. And it's just important to just kind of be in touch and communicating about what it is that you're working on and where your goals are and where you want to be. And then we can then tax affect that, because we always want to make the right decision for you, not necessarily only the right decision for tax.
Awesome. All right. So we answered some questions in the chat here. If you have a question, you can reach out directly to me through LinkedIn, Larry through LinkedIn, or Patrick, as well as reaching out to us on our website, proseer.co. We have a contact us page. You can reach out with any questions there, and we'll be sure to get back to you. Thank you so much for attending. We are working closely with our clients. If you're interested in learning about our services or how the new tax bill might impact you and how you might be able to take advantage of some of the opportunities, please reach out, proseer.co/contact, and we look forward to talking to you soon. Thanks, Patrick. Thanks, Larry.